Welcome investors to my channel Fiscal Voyage. My name is Felix and this video was brought to you by Ryan Richard. He commented in a previous video and suggested me to do a stock analysis on Verizon. And yesterday I did another video on at&t, so we have a good comparison on today's video and yesterday's video to see which one is a better buy at today's prices. Make sure to go and check out that yesterday's video of at&t. And also let me know in the comments what stock would you like me to analyze next. And if you're new to the channel, make sure to hit that subscribe button for more videos and stock analysis of different companies. So let's get started with a stock analysis on Verizon. Alright, so here's the stock analysis on Verizon Communication Inc. The company is a multinational telecommunication conglomerate. And in 1984, I'm sure you guys didn't know about this, the United States Department of Justice mandated at&t Corporation to break up the Bell system into 7 companies. And one of the company was called Bell Atlantic, which later to be known as Verizon. And I'm sure you guys heard of Verizon, and probably some of you have a service with Verizon. They provide internet services, telephone services, for telecommunications. And again, make sure to check out my last video on at&t, and you can see the difference there. So let's continue with fundamentals. Revenue grew at a modest rate of 2.4% from 2010 to 2019. Net income had a much better rate at 25.9% in that 10-year period, and this was because of operating margin increased dramatically from 13.7% in 2010 to 23.1% last year. So that's why net income had a tremendous increase after that 10-year period. And the company has a good investment grade BBB plus rating with S&P credit, and an operating income earnings growth of 8.5% in that 10-year period, and earnings growth at 8.7%. However, the past 5-year average for revenue, net income, and earnings has been decreasing. For example, revenue 5-year growth is at 0.1%, so basically flat. And net income for the past 5 years with a 1.9%, so it has been decreasing versus the 10-year average of 25%, because operating margin has been flat around the 20% or 23% in the past 5 years. And earnings growth again 4.8% compared to the 10-year average of 8.7%. So revenue, net income, and earnings has been decreasing in the growth rate section, so that's something to consider. So let's continue with the fundamentals. For 2019, the company had earnings of $4.81. Net margin came in at 14.6%, and return on equity at 33.6%. Net margin did increase, did expand from 2018 at 11.8%, so that's a positive. And the last quarter it decreased a little bit, but not substantially. Current yield, the company has a 4.42%, which is a fairly decent, attractive dividend yield. And however, they have a very low growth rate of 2.5%. In my last video with at&t, at&t has a dividend yield of over 6%, and with the same 2.5% or 2% 5-year growth rate. So at&t wins in this battle here with the yield and growth rate. However, they do have a good coverage with a 51.7% dividend payout ratio, which is very substantial in a sense that is well covered. So that's positive there. And however, if you see the current yield at 4.42, the 5-year dividend yield average is 4.48. So it actually means that the company current yield is less than the 5-year average, which might be a good indicator that it may be fairly valued. And we'll see that at the end of this presentation. We'll see the fair value price. And the most recent dividend increase, well, first off, the company has been growing dividends for 15 consecutive years, which is very positive and attractive. I like that a lot. However, the most recent dividend increase only was 2.1% in September. And so the next dividend announcement should be an increase again at 2%, because they already paid out 4 quarters with the same dividend. So I expect an increase in September. So let's look at the balance sheet, which is a lot better than at&t's, but we'll go over it here. Debt to cap is higher than AT&T's at 62%. The current ratio is much better at 0.99, where AT&T's I think was 0.5 or 0.6, I'm not sure, but check out that my last video there. Debt to equity is at 2.31, which is fairly high but manageable, and the interest coverage is much better than AT&T's, where it was, I think it was 3.3. This one is 5.75, so they're able to cover their interest quite nicely there. And the price to book ratio is much lower than the 5-year average you see here at 3.83 versus 7.81. So let's look at the future outlook and what analysts are expecting for Verizon. 2020 earnings expect to be $4.76, and 2021 $4.90, and CFRA has a projected earnings growth of 2%. This also goes in line with their past dividend growth rate, because most companies, based on earnings, is what they increase the dividends for the most part. My dividend yield return models came in at a total projected return of 10%, and we'll see that in the fast graph also. Is quite lines up nicely there. This is a little lower than yesterday's video of AT&T, which had, I think it was 11%. The forward PE is at 11.6 versus their 5-year PE average of 13.7, so that's very, it's attractive there at a lower PE now versus their 5-year average, so that's good there. And let's look at the fast graph. Black line is the monthly closing price. The blue is the normal PE of 13.9, or you could say 14, and the orange is a PE of 15. As you can see here, the company for the past, I would say 3 years, has been under both the blue and orange line, and you can see how the black line has been trending up. So that's a good indicator that it may be undervalued, and you can see here the total annual projected rate of return of 13.2% for the next 3 years is very good return. The dividend yield, as you see, 4.42, and the blended adjusted earnings yield at 8.6, so that's much better than the 6.5 minimum criteria. So that's good there. And the BBB plus investment grade. And one thing I want you guys to notice is that in 2013, if you were to bought shares of that company and held on to it till now, you basically had about a 1% to 2% annual rate of return. And that's because in 2013, the company was overvalued. It had a PE of almost 20, around 18 to 20. So that's why the lower PE versus the 5-year average is always good to look at, a good metrics to look at. And you can see if you were to buy in 2013 and held on to today, it looks flat. It's been around the 40 to 50 range this whole past 7 years. You weren't earning anything. But if you bought shares at 2015, around when it was under both the orange and blue lines, then you started to make around 9% annual rate of return till today. So that's valuation is so important. Even though the company was growing earnings, as you can see in 2013, it had 22% earnings growth and 18% in 2014 and 19% in 2015. The company was growing earnings, but the price was overvalued, and that caused for underperformance. So that's why it's so important to purchase companies at a good valuation. So speaking about valuation, let's look at the fair price for Verizon. CFRA has a fair price of 56, Morningstar 59, Fast Graphs we just saw at $66.54, Yahoo at $60.20, and my dividend discount model analysis at $35.85. My dividend discount model analysis, I use 2% dividend growth for the next 3 years and 2% after that, with a discount rate of 9%, gives me the $35.85. So I mean, if you look at the others, you can see here that they are a little over $56. They look to average around $59 or $60. But if we average out all 5, we get a fair price of $50.61. Currently, the company goes for $55.63, meaning it's right there at fairly valued. Actually, slightly overvalued by 0.03, but I'll just say that's fairly valued, give or take. But with this valuation, that's why I have a recommendation for Verizon with the low dividend growth and the lower yield than AT&T as a hold. So I have a hold recommendation for Verizon, and that's because of the valuation. The biggest thing, the difference from the AT&T video yesterday and today's Verizon video is the valuation. AT&T was undervalued by 18%, and as you just saw, Verizon is basically fairly valued. And the next biggest thing is the dividend yield. They both have the same dividend growth rate, about 2 to 2.5%, which is not great, but okay. And the current dividend yield is much higher with AT&T than Verizon. Verizon does have a slightly better balance sheet with the interest coverage that's much higher than AT&T's. But again, AT&T has a projected annual rate of return of 22% for the next 3 years, and that's because of the valuation and the dividend yield. Where Verizon only has a 13.2% annual rate of return for the next 3 years. So there's a big difference in the two companies. That's why I have AT&T as a buy and Verizon as a hold. And that's why AT&T is a much bigger position for me than Verizon. And I do own Verizon, but it's only a fairly few amount of shares. I actually bought it during the March lows. So I've been up since then. But at current prices, I have a hold recommendation for it. So if you have a stock that you would like to have me analyze next, make sure to leave a comment below. And also, if you're new to the channel, make sure to hit that subscribe button, and I'll see you guys in tomorrow's video.